Hey everyone, it's Mike Curtis with Trader's Edge Network. I'm here with Preston the Pirate James, founder of Trader's Edge and creator of the Money Press method trading system. And the point of the video today is we're going to break down everything that's in this guidebook. Preston's 30 plus years of trading and market experience packed in to this little gem. We're going to go over all the important details you need to know about the trading system, some of the important topics in this book. But Preston, I wanted to start with something a little bit different. Why don't we kick this off and talk about what the Money Press trading system, what it is not?
Great to join you, Mike. I love that we're doing this. First of all, it's not some secret indicator or any of the technical analysis voodoo, which now has spanned hundreds and hundreds of terms. It's not having a bunch of screens and feeling overwhelmed by the market every single day and being glued to those screens all day long. It's not trying to pick the next Apple or the next Home Depot, right, or the next stock and holding years and years and years onto something, right, hoping it turns into the next whatever. It also doesn't require scads of money, big account sizes to do. Heard that joke over the years. How do you get to have $1 million in your account? Start with 10 million, and anyway. And it's definitely not a get rich quick system.
Right. Yeah, and people love it that they're not glued to the computer. Their life fits around the trading strategy, not the other way around. And we're really just combining the market forces that are in play anyway and the probabilities out there. And you've really tailored this trading system around a lot of this, just the probabilities that exist in the market anyway. So maybe we could just talk about some of the things that the trading system is, just build on that a little bit, and how it works with the world's top stocks. You don't have to deal with tens of thousands of stocks. You're really looking at just a few hundred, and it's a powerful skill you can teach others that you care about. You can teach others how to use this for generations. It's just a system people really love to execute and trade. What am I missing there, Preston?
Well, I think you'd just be proud being an investor or trader again, just with the consistency, the built-in sleep at night protections. I love that you mentioned sharing this with people you really care about. How about chiming into a conversation and, hey, yeah, I'm dealing with Microsoft. I'm dealing with NVIDIA. I'm dealing with, I don't want to mention all the names. I mean, you're dealing with basically the Bentleys. Mm-hmm. If we're talking about automobiles, these are the Bentleys and the Rolls Royces, right, of the trading world.
No doubt. Yeah, and it's just, we pride ourselves in trying to take a topic that's a little bit complex, but breaking it down, trying to keep it simple. We make sure you're controlling your risk. You can sleep at night. And it's a system that tens of thousands of traders over the years have adopted and seen a ton of success about. So on that note, Preston, why don't we dive in? We're going to get to the book, but for those who don't know you, maybe just give yourself a quick introduction, some of your background, why you founded Trader's Edge, and then we'll start diving into the book.
Yeah, I mean, just going back, I know I'm a very passionate person. I was a walk-on linebacker in college. I earned a full ride scholarship, got to be a 2-year starter. For me, it was just something that was going to happen. I just figured, all to say, I took that into business. I just knew whatever I was going to lock onto, whatever was going to light me up, I was going to make it happen. And it's been a journey. Mm-hmm. I got a finance degree out of college. I went into the brokerage business. Quickly found out I was super excited about stocks and their potential, but kind of icked out, ICK out of the brokerage part of it. Right. And I tried being a swing trader at first, and met Dr. J, John Najarian, in a freak kind of a way. And we kind of bonded because we both had a linebacker past. But When weeklies came out in the spring of 2010, that's what changed me forever. And quickly, that's how the money press method was born because of, anyway, my passion going through making money, losing money, making money, losing money with the swing trading, and then having the weekly options come out.
Yeah, no question. And the power of those weekly options just opened up a lot of doors. That really encouraged you to continue on this path of trading options. You talk about in the book, you ignored an opportunity to get in a restaurant franchise for Buffalo Wild Wings, a B-dubs. And both of our parents, Preston, both of our fathers came from like that real estate development world. And we love the fact that with just a quick click of the button, you can get in, get out of investments instead of waiting weeks or months or years to get in or out of deals. So there's a lot of really amazing qualities with being an investor in this weekly options world. And we're going to hit on that even more as we go throughout the video today.
No, absolutely. I talk about the carbonized shit theory too. And what this is just really how there's just tons of advice, and we're in information more drowned in ideas in the world, more drowned by information and ideas than ever. So the point of that is you do not have to be trapped by what the conventional wisdoms are, from annuities to mutual funds with all these fees, and just how kind of the Wall Street powers that be want you to be as an investor.
Absolutely. And that in the guidebook, that's page 18. If you've got your copy out, you can work through some of that. And Preston, just to throw my 2 cents in there, you know, I graduated high school and I dove right into the world of trading as I started working with you here at Trader's Edge in 2003, had the opportunity to work alongside you, trade alongside you, mentor a lot of individual investors in a one-on-one situation, our awesome Trader's Edge clients. And I just have to say that the money press is such an amazing, beautiful trading strategy that just kind of gets people out of their own way. So I'm really excited. We're going to dive in, take you through the main ideas and concepts of the Money Press Guidebook. Try to do it in kind of a quick video here so you can get through some of this information quickly and get going, get on the path to actually going live, trading your first money press as soon as possible. All right, let's dive in. So we're going to talk about some of the key foundational concepts about this money press trading strategy. And Preston, as we work into that, could you explain why right now is such an amazing time to be a weekly options trader?
Well, all we have to do really is look no further than this chart, this graph that we have on the screen that shows the growth of weekly option trading volume since the weeklies were created back in the spring of 2010. I'm fond of saying where the people go, the money will flow. And for some reason, Mike, you didn't create it and I didn't either, but the world is very interested in a growing way of what happens to the stock price in a shorter and shorter period of time. This is what's behind the growth of these weekly options. And it's a perfect circumstance to not only learn the money press, but to continue doing it, because I don't see this abating anytime soon.
No, not at all. And it slides right in. You talk on page 32 of the book, the 3 certainties of life: death, taxes, and the time decay of options.
That's right.
It's a predictable force. These options have a shelf life. They have an expiration date. You know that before you trade them. And as it gets closer to that expiration, they consistently lose value. And, you know, you could fill in
That's a good thing. That's a good thing.
It's a good thing. As an option seller, which we'll explain more here in just a minute, that time decay works in our favor. And what's even more beautiful and powerful than that is these weekly options have actually built in more income for us versus the old monthly options. And we really have less or even the same amount of exposure or risk on our money press trades. We can actually get to Preston. We can break this out for the folks here in just a second on the whiteboard, but how these weekly options can actually double our potential income.
Absolutely. And as you're fond of saying, Mike, it's not difficult. It's just different. Absolutely. I'll let you take it away and explain that.
Yeah, let's jump on the whiteboard and we'll hit on some of these topics real quick. All right, I want to show you how these weekly options can be so powerful and work in our favor. Now, we're going to get into this a little bit more, but we sell a weekly put option. When you're the seller of an option, you want it to lose value. For example, you want to sell it for maybe $2. Someone's paying you, and then at the end of the week, come expiration Friday, we want to buy that back for maybe 10 cents or maybe a nickel. All right, so think of the transaction in reverse. If we bought something for 10 cents and then we sold it for $2, you'd make a $1.90 profit. So as a put seller, we're just doing that transaction in reverse. So it's really not difficult. It's just a little different to wrap your brain around this. So someone's handing us $2. We're selling something that we don't own, by the way, but we can sell this put. We can get handed the $2, and then we want that to lose value. And if we buy that back to close out the transaction, we make that same $1.90 in profit. So let me show you how this time decay really works in our favor. So this is a graph here of an option time decay chart. It just shows us, because every option contract has a shelf life. It has an expiration date. And we know this before we even start the trade. We select which option expiration, which shelf life, if you will, we're going to utilize before we even jump into the trade. So I want you to look at these last 30 days down here, right? So here's the last 30 days where an option is going to go from here is in regards to remaining time value all the way down to 0. All right, that's the last 4 weeks approximately. So if we break this up, we slice this up into 4 weeks. I'll do this the best I can here. But you can see this last week is literally the steepest, most aggressive point where these options are going to lose value. So if we're selling something for $2, over the next week, if the stock goes sideways or down a little bit or up a little bit, this time decay is rapidly going to work against this to where we could buy it back a week later for hopefully next to nothing, creating a really nice profit for us. All right, so we're going to talk about this more, so don't get too hung up on this, but I had this really amazing mentor who helped me when I first got started trading, a couple decades ago now, and he managed a hedge fund for a while, really brilliant trader, and he would always tell me this. He said, Mike, do you want to know what I think the market's going to do tomorrow? And I was like, yes, what? Tell me. He said, I don't know if it's going to be up. I don't know if it's going to be down, but I know it's going to be open for trading. And what his point was we know that tomorrow we're going to be 1 day closer to expiration, that this time decay is going to keep working against these option contracts. That's the one thing we know for certain when it comes to trading in the financial markets. So we're using these forces that are built in, that are happening no matter what, and we're putting them in our favor with the money press trading strategy. So we're selling something that's going to experience the most rapid time decay that it will ever experience. And then the money press is a 2-part trade. So we're also buying some protection. We're buying some insurance. And guess what? When you buy that put protection, that time decay is now working against you. Okay, so we're buying out in here where the time decay is working against us much less. So again, we're going to elaborate on this, but really I wanted to give you that kind of 35,000 foot view of why these weekly options can be so powerful and work in our favor. We're experiencing this rapid time decay. And you can look across this chart here. There's no other period that experiences that big of a drop. Boom. It's going from this level here, this dotted line, to 0 in that last week. And as an option seller, that works in our favor. That rapid time decay works for us. So again, just to get the wheels spinning, I wanted to lay out this time decay curve and show you how these weekly options are just naturally set up to take advantage of these forces. So hopefully this makes a little bit of sense. We'll keep rolling here. All right, let's keep rolling. We're going to break down a little more of what the money press actually is, and it is an option spread trade. And Preston, you like to use the example, right? We're selling weekly income. It can generate that income for us, but you use this expression of becoming a time merchant. It's on page 36 of the guidebook. And we like to use the analogy of kind of a vacation rental property. Instead of, signing a 1-year lease, getting someone into a rental home, if you're renting this thing out week at a time and it's near a beach or it's near Disneyland, how you can just generate so much more income in that environment. And that's kind of your concept of becoming a time merchant. Am I right?
Yeah, exactly. I mean, we are in business, and you just have to ask, right? What's your service or your product? Well, we're dealing in time, and just like you broke it down, I mean, for shorter periods of time, you're going to pay more versus what if you rented a place for a month? You're going to get a better deal. But if we turn around and sell things and chunk things out on a smaller period of time, that greatly benefits us.
Yeah, so why don't I jump back on the whiteboard again? I'm going to show these two different pieces of the money press trading strategy, how this is an option spread. I want to break down and show you in some real numbers how we can actually double our income potential by being these weekly option sellers, and explain a little bit more, like we talk about on page 40, our oil tanker and wave runner analogy. So let's dive into the whiteboard.
And I'll add one more thing. Usually doubling your income involves adding more risk.
Right.
This is the part that kept me up well into the morning hours when the weeklies first came up. I discovered you can double your income with no additional risk. Right. Sign me up.
Amazing. All right, we want to just keep helping you visualize this money press, the structure, and how this option strategy can really just keep stacking the odds in your favor. So like we've mentioned before, the money press involves two different options. It's an option spread. So the technical definition, if you were to call a broker on the phone, say, hey, I'm trying to do the money press, they might be like, it is an option spread trade. Okay? It's an option spread. And what a spread means is you're just dealing with two different option contracts at the same time. And like we mentioned before, we're going to be the seller of a put contract and the buyer of the put contract. So again, just to kind of give you the overview, we look to sell a put, and this is our weekly expiration, right? So this is going to expire in 1 week or less, right? If you're building the trade on a Friday, you're using that following Friday's expiration. If you build it on a Monday, that current Friday's expiration. So you're using this weekly expiring option. And again, we do that to capture that rapid time decay that we showed you in our previous little whiteboard video. Now, the second part of the trade is we're going to buy a put. And we're going to elaborate on this a little bit more in a future video. But the idea of that is it brings your cost to build the trade down, where now, it might only cost you a few $100s. Instead of, if you were trying to sell a put by itself, it might cost you several $1,000s. right? So I've seen one example of a trade where the broker wanted to hold like $10,000 to sell a put by itself, where if we build this as an option spread, it really brings down our cost. It might only cost you maybe $800 to put one of these trades on. Okay, so we can take advantage of this weekly put in the rapid time decay, and then we buy this put that might be, 2, 3, 4 months out in time. Okay, so we'll just call it 3 months out in time. All right, where very little time decay is working against our protection, our insurance that we're buying. All right, so this can now last us, right? If we're going to be in a trade for maybe 10 weeks here, we have the opportunity to bring in weekly premium week after week after week after week. And this put protection is here that we can keep utilizing for several months. Again, if we're in a trade for the typical money press is maybe 8 to 12 weeks, this put protection can cover us for maybe that entire period. There are times where we need to adjust that, and we'll talk about that later. But the idea is, if we bring in $2 here, this protection down here might only lose 20 cents for the week. Okay, so overall, we've got this really nice gain coming in. All right, so we're holding this protective put, and that enables us to generate this weekly income, right? It's that vacation rental property where you're just every single week a new chunk of income rolls in. All right, that's kind of the concept. Now, one thing it's never been better to be an option trader utilizing these weekly options, because before weeklies, you would have to sell maybe 3 or 4 weeks out. And guess what? If we were to sell 4 weeks out in time, if we were to sell one monthly option, we might bring in $4 for that. But now with these weekly options, we have the opportunity to bring in $2, $2, $2. You total all that up, right? And we have the potential to generate $8. The math almost always works out right around this number where it's double or close to double the amount of income by using these weekly options. So it's never been a better time to trade options and be a weekly option seller. We get to double our income potential. And guess what? We've added literally zero extra risk because this protection is still there. And being individual investors, being individual traders, if you go look at page 40, we have an example of this where we compare the big institutions. They're kind of these big oil tankers, right? That to do a 180 U-turn, these big oil tankers, it would take them, 30 minutes, an hour to get this giant oil tanker to turn around. Us as individual traders, if we're just doing a few contracts, maybe 10, 20 contracts at the most for most people, we're kind of like a wave runner. We can cut and maneuver and change directions just like that. So not only do these weekly options set us up for double the income versus the old traditional monthly options, not only do they take advantage of that really rapid time decay, but us as individual investors can utilize these at just breakneck speed. We can just really execute these, and we're only exposed to what the market might do over a week, and then we get to adjust the trade. So there's just so many forces, so many factors that really light up this money press trading strategy. I hope you're getting really excited about it, and we'll continue to build and learn more. So you can tell we're pretty passionate about this, and hopefully you're starting to get a really clear picture of why we think these weekly options are such an amazing investment vehicle. How it can just give you fewer stocks to deal with, and they're usually the better, more well-known kind of blue chip stocks. it provides these frequent weekly income opportunities, and really with that limited exposure to these market fluctuations. And I love the visual, Preston. I know we've talked about this before, where collecting these weekly premiums, you're just exposed to the market kind of a week at a time, and then you get to adjust. So it's almost like walking down a steep hill. I know you like to hike. You're going down a steep descent. You're going to take these controlled, smaller steps, right? Instead of taking these large strides, risking, losing your footing. And the money press really kind of works in that same regard. Is it's just little less exposure, but yet we have all this crazy income potential, not to mention all that volume that's in these weekly options that just make trading really efficient. Have I missed anything?
No, it's crazy. And also the fact that, stocks can break out and move, but a lot of times they'll just stay sideways for quite a long period of time, kind of not going anywhere.
And we can profit in that environment, right?
Absolutely.
If the stock goes sideways, where most traditional investments, you're just sitting there, your money's tied up, you're not making any return, the money press can profit. So that's a great segue into, let's start breaking down more of the mechanics of the money press. All right, so let's keep building on this concept of how we can become a weekly time merchant. We can collect these weekly tolls, and we do this all through this money press trading system. So we like to imagine you own a toll road, and every car that's just driving by, they're paying this toll, right? We use that weekly vacation rental example. So we're going to dive in and show you how this comes to life. And Preston, you love your Baskin Robbins example, so I can spell some of that onto the whiteboard, but you want to give a little teaser of what that is?
Yeah, I mean, the employees don't have to be that good. You don't have to advertise during the Super Bowl. All you got to do is buy ice cream for about $35 in those 3-gallon tubs. And if you Google this, you can get about 95 scoops out of there, and they're charging close to 100, round it to 100. And you're charging $4.50 for a single. And,
right.
The math just works for you. It's very forgiving. Even if you've been a really soured, unlucky trader in the past, the math is so slanted in your favor that it just turns out to be a really, not to mention all the other benefits, it's just kind of fun to be a money press trader. And we have taught people, and I know, Mike, you're a veteran of coaching over 500 of Trader's Edge students over your time before you moved into just where you are right now. So what this has turned into over the years is, me personally, I do the money press for about 70% of what I do in my portfolios. Mike, I think you're about the same.
Yeah, it's the majority, yeah.
And there's other strategies that I love doing that are opportune for certain markets, but the money press is the main backbone. And Mike, I think you're going to break it down and show a real example here.
Absolutely. So let's jump back to the whiteboard. I'll break down kind of what this Baskin Robbins example is really quick, but then what I'm sure you've all been waiting for, let's start working through an example or two of what this money press looks like. All right, let's talk about ice cream. Yep, you heard me right. I want to use a Baskin Robbins example, so hopefully that gets you to pay a little attention here, you ice cream lovers, and tie that into the money-making potential of our money press trading strategy. So, Baskin Robbins, you'd rarely see any advertisements. They've been around forever. Those things stay in business, and it's all about their profit margins, right? They have these 3-gallon drums of ice cream here that I think they pay about $35 for, okay, in that ballpark. Now, what they can squeeze out of these 3 gallons is about 100 single scoops, okay? So imagine 100 of these, and most places are selling these scoops for about $4. Okay. So you do the math on that, right? They've got $400 coming in with a hard cost of about 35 bucks. So amazing, amazing margins. And, you know, if they don't sell out all the ice cream one day, they keep it in the freezer, they can use it the next day, right? They're not going through too much waste. You've got a few teenagers that don't need to be trained very much. I mean, they just are scooping some ice cream. It's all about buying in bulk, right? Buying at a low cost, right? Think Costco, and then selling at a premium. So let me show you how this ties into our money press. So we've talked about the time decay curve and how we buy our put out in time, right? We're buying this put maybe 3 months out in time. This is like we're buying in bulk, right? The time decay isn't affecting it as much. And then we sell our weeklies. And this is like selling off our single scoops, right? We sell these weekly puts. So we're able to pick off this premium and generate this income week after week after week. We're getting top dollar, right? We're experiencing that rapid time decay like we talked about. We're getting that premium amount and we're buying that protection in bulk. 3 months out in time, little time decay working against us. So Preston talks about that in the guidebook. It's a really fun section to hopefully help you connect some of these dots just a little bit on how this really makes some money. But let's dive in now to an actual money press trade example so you can really start to visualize a little more of the nuts and bolts. All right, so let's just use a hypothetical example. We've got a stock that's trading, we'll just say right at 100. And this will make my math easy. And this is a hypothetical, but the math, the numbers on this is really similar to real world examples. Okay, so if a stock's trading at 100, we want to come in and we're going to want to sell a 100 strike price put. Right? So when you go to an option chain, you're going to see all these strike prices. Usually it's right down the middle of the option chain. We want to pick the 100 out. Now, we could spend an hour or two talking about the why, but this at the money strike, right? If the stock's at 100, the closest strike price to that actual stock price is the at the money strike price. That has the most time value built in, right? And we talked on that time decay curve. That's going to experience, these weekly options experience the most rapid time decay ever in that last week. So we want to bring in as much time value as we can so it can experience that rapid drop off. And that at the money option has the most time value of any option on that option chain. All right. So again, that could be a long discussion in of itself. So you just have to take my word for it for now. But that's how we pick which strike price we want to sell. Look at the stock price, which strike price is closest to that, and then we just look for the option that's expiring a week out, right? This is a weekly expiration. So if we're trading it on a Friday, we're just looking at that next Friday's expiration. So we're never going to be in one of these for more than a week, right? If we build the trade on a Monday, we'll be using that Friday's option. If we build it on a Tuesday, same thing. Okay, so you're never going to be using an option more than a week out. All right, so we're selling this 100 put. It's a weekly option. Okay, so we've got to pick a couple of these things out as we're building the trade. We got to select this. We got to select the expiration, right? We go weekly. And then whatever it's trading for, we'll be able to see that on the option chain. So let's say this one's $2. And as we sell this option, that money comes into us. Then we would come and we would buy one just a little bit out of the money. In this example, we'd probably buy a 95 put. Now this is our insurance side. Okay, so we want it to be out of the money just a little bit, right? So a little bit away from our stock price, a little bit away from this at the money strike price. And this might be, 3 months out in time. All right, and again, you'll look at an option chain, see what's available. Okay, so we're lining this up where usually you don't want this put to be too far away where it's not protecting you. You don't want it to be too close where you're buying like Lamborghini type insurance on a Toyota Camry, right? We want to have this usually, on a $100 stock, it's about a $5 spread. If it's $150 to $200 stock, usually it's about a $10 spread. Okay. Above there, sometimes we get to maybe a $20 spread, but not too often. And by spread, I mean the difference between these two strike prices. Okay. Now, this might cost us $5. And again, this is 3 months out in time. So we're going to be able to sell week after week after week after week and potentially utilize this protective put, this bought 95 strike price put for several months. All right, so when we first build this trade, when we first build a money press, we've got $2 coming in. We've got to put $5 out. We're buying, we're spending that money. So net, what we call this in the trading world is this is a debit to our account. Okay, this is a debit. And it would be for $3. Right? If someone's handing us $2 and then we've got to hand back $5, we're out $3. All right, so we would put in a limit debit order, a net debit order, however your broker phrases that, and that's getting the trade going. Okay? But as we generate this weekly income, it will way surpass what we've spent on that put. And remember, this value, this $5 investment, that doesn't disappear overnight. Remember that time decay curve? This might lose just a little bit of value for the week when we, maybe 20 cents or something where this brought in $2. All right, now there's one other cost. We call it collateral to get a money press trade going. Because what the broker sees, they don't understand that we're going to be selling a put week after week after week after week. They just look at what you have right here, right now. And what they see is, okay, when you sell this 100 put, you might have to buy stock at 100. But then you have this insurance where you could sell it to someone else at 95. So the broker sees $5 in some downside exposure there. Okay, that's our downside risk if the stock were to have a really rough week. All right, so let's walk through just a little bit more of this math. Again, math hat on. I promise this gets real exciting real fast. So this is our collateral. Okay, I'll abbreviate it here. Also known as our margin requirement, what a broker would call it. Now, you're not using margin. You're not borrowing money. It's just going to tie it up in your account. So the total to put this trade on is about $8. All right, now in the world of options, what that means is it represents, every option contract represents 100 shares of stock. So anytime you see it quoted like this, on an option chain or you're putting an order in through your broker, we know that cash money, that's really $800. Okay, so the total cost to get a money press going here is $800. Now you have to have the right margin requirement set up with your broker. Easy to do. We'll take you through all of that. But this will cost you a mere $800. And look at what the income potential is, right? Again, $2, but that's representing 100 shares. So cash money, that's really $200. You get trading options, your brain just moves that decimal place over 2 spaces, and you just don't even see it anymore. You just start seeing $200, okay? So our potential income, right? Let's do some math here. Our potential income is $200. And our total cost, our total expense, what would tie up in our account, we've got to spend the $3. We're buying that. We're buying that insurance. And then the broker's going to just tie up that other $5 in collateral. So we have $800 total cost. Okay, that's our total cost. That's our risk if the stock were to have a really rough week. And then if the stock goes sideways, if it goes down a little bit, if it goes up, we can make this profit. So if the stock, were to hang right around 100, we could make that entire $200. If you look at the ROI on that, we're talking 25%. And again, I know this is a hypothetical, but this is really similar to a lot of numbers you'd see if you went and found a $100 stock out there. Okay, the stocks that we like to trade. All right, 25%. Now, this isn't for a year. This isn't for a month. This is for 1 week. Okay, a 25% return on 1 week. So you start to have some fun with this, right? How many of these $200 that starts rolling in would it take to really start to change your financial situation, right? If you're trading even with a small account, a couple $1,000s, you could go get maybe a couple of these trades going and have the potential to generate $400-$600 a week in income, right? Now, is every week going to go perfectly? No. We'll talk about that more. But this is kind of the best case scenario, and it's pretty amazing and exciting. So, quick recap. Stocks trading at 100. We would sell that at the money weekly put, bring in some nice income. We'd then go buy a little bit out of the money, right? In this case, about a $5 spread. The difference between this strike price and this strike price, $5. We're going to look 2, 3, 4 months out in time. Okay, so if there's a 3-month out there, go scoop that up. It's going to cost us about $5. And we have the potential ROI of 20-25% per week on some of these. So tons of fun, tons of opportunity. Hopefully you can start seeing how this comes together. And in the book, there's even more examples like this if you want more. All right, let's keep breaking down some of these money press mechanics. And I love on page 50 of the guidebook, Preston, you kind of talk about how this strategy can be forgiving. You don't have to predict the market moves. It just really leverages this time decay that's happening against these option contracts naturally every day. So maybe you could talk about that just a little bit.
Yeah, I mean, you can just tell, even as a market bystander, that the market can get really volatile. It can be more volatile than at other times. And what happens during that time is there's a lot more gambling, and the option pricing rises with more uncertainty. And with a strategy like the money press, we put that extra premium in our pocket. Now, nothing's perfect, and I'm not saying that there's no risk involved.
Yeah, that's a super important point. We talk about it on page 52, having a baseball player mindset, right? There's going to be some weeks that the trade doesn't perform, and that's okay. That's to be expected. And I love teaching this concept to people where I break down, hey, if you've got 4 weeks in a month, in 1 week is a train wreck, you lose, maybe 1 week's a break even, but the other 2 are profitable, you can still just see an incredible rate of return with the money press that's just blowing away most other opportunities out there. And a big piece of this too is just really understanding the risk, understanding what you love to call, Preston, that sleep at night protection that's built in to every single money press trade, where you know exactly what your exposure is, what your risk is before you place that trade. So why don't we jump back into the whiteboard and we can break down some of this a little bit further. Now, as any savvy investor knows, it's all about controlling your exposure, controlling your risk, and balancing that against your reward, right? Risk reward ratios, really factoring in, what's my upside here versus what's my downside. And what we absolutely love about our money press trading strategy is that exposure before you even start the trade. Okay? And we talk a lot, you'll hear Preston talk in the book, and as he teaches here and there about our sleep at night protection. Right? We've talked about how the money press involves selling a put. That's kind of our income side of the trade. And then the other side is where we buy our put. And this purchase down here, that's buying our insurance. We know as we come in, we use that example in the last video of using like a 100 strike price and a 95 strike price. So if we line this trade up before we even place it with a broker, we know that we have this $5 of exposure here between these two strike prices. We know that we have that risk before we even place the trade. So not only does it act as this sleep at night protection, but it also brings our cost of putting this trade on, it brings it way, way down. So again, just using the same example as before, if we had $200 of potential income there, right? If it's $2, we know option contract represents 100 shares. So we've got this $200 of potential income. Well, if we were just trading this with just the income leg, the broker, depending again on your few different factors, if you've got options clearance and how the broker operates, they might want to hold up to $10,000 of buying power to generate $200 in income. Okay, but by executing this trade the way we do it, by generating or by buying this sleep at night protection, not only does it put that floor on our exposure, but it also brings our cost of building the trade way down. So like I showed you in that last video, we have a $3 debit, and then we have that $5 in collateral that the broker is going to want to hold, that downside exposure. So we could build this trade for cash money, $8 or $800, right, as it represents 100 shares. So we know that by tying up 800, we have the potential to make 200. We know that we've got this $5 in exposure here to the downside. So we can size all of this up before we jump into the trade, and we can make that decision if we like that return on investment. And we know how many contracts we should go trade based on these numbers. And we know this before we even jump in and execute the trade. Now, I want to talk about one last thing, because this return on investment, some of you might be thinking, oh my gosh, this is it too good to be true? Well, you're not going to hit 100% profit every single week, right? We talk in the book about having a baseball player mentality, right? You think of some of the best baseball players in the world, some of the best hitters in the world. They're batting around 300, right? So that means they're failing twice for every one success, okay? So they have a hit, and then they have two failures, and then they have a hit, and they have two failures. And because we've tracked baseball stats for decades and decades, we know that that's a good batting average. We know that that's success as a hitter. So when it comes to trading, you have to adopt a little bit of that baseball player mentality. We know we're not going to hit 52 weeks out of 52-week winners. We're going to have some losses in there. And I like to run through this example. You know, let's say you size up a full month of trading, right? And you've got 4 weeks approximately for this month, right? Let's say 2 of those weeks go beautifully, right? You make that 25%. Okay, 2 weeks go beautifully. And this might be in varying orders, right? But then 1 week, maybe you lose 25%. Okay, it goes against you. It's a rough week. And then maybe 1 week you just break even, right? It's a big goose egg. It's a zero. Well, even in this scenario, right, that might be a choppy market, a little more realistic, the stock's not behaving exactly how we'd like. Even in this scenario, you're still hitting a 25% return for the month. Okay, it just absolutely is phenomenal potential. So, like that baseball player, you might get a hit and then strike out twice, and you might be one of the best hitters in the league at the end of the season. We're going to have weeks where we have a loss. We're going to have weeks where we break even. But over time, right, if we stick with this money press for 8, 10, 12 weeks, the math is just slanted in your favor, right? It's that Baskin Robbins analogy. We just have margin potential here, these profit margins, and it really gets exciting. So hopefully you're really wanting to roll up your sleeves and understand this money press better. The goal of some of these videos is just to get you thinking, understanding what this concept is. And you're well on your way to seeing some of these really exciting ROIs. Can't wait to hear all about your success. Hopefully at this point, you're super excited about getting started with the money press to start seeing some of this weekly income coming your way. So just to recap, Preston, what are some of these main advantages, the really exciting points of the money press before I jump in and show everyone kind of what their next steps are from here?
Well, first of all, I don't know where to start. I have a wall over here full of, I'm old school. I print out stories we hear back and testimonials. I clip them, I tape them up. I have a whole wall full of, and I've got tons more. I'm going to run out of wall space. So that's one thing. For this particular strategy, oh my gosh, dealing with the best of the best of the best stocks in the world, defining and containing the trade first and foremost, which is what the money press does with the worst case scenario, which can always happen to anything. Containing that. I also love every time I turn around, it's a Friday. The weeks just zing on by. Sometimes the week seems like days and the days seem like weeks. I love that. Mike, last winter, I remember looking over on the chairlift and you had your phone out. I thought you were texting with your daughter or something. You were doing a freaking trade adjustment on your money press. Took your glove off, whipped it out and did it. So the fun factor, I mean, I don't know where to begin and where to end on this.
It's just really, it's never been a better time to trade this, right?
Never been a better time in history to be a trader because of all these
coverage everywhere, Wi-Fi everywhere. You know, I was just down on a beach in Mexico with bad cell service. I jumped on the restaurant's Wi-Fi, and you're able to trade. Whether you're on an airplane at 35,000 feet, you can plug in and trade. You can really do this from anywhere. And there's so much potential. And it's just, again, it's not difficult. It's just a little different. You can wrap your mind around it. So why don't I dive in, Preston? Any other closing thoughts on that? Or should we give people some ideas of where to go next from here?
No, just the team hub and just all this other stuff that we put together to just make this the best, the quickest journey to making money, the less stress-free and less headachy. So take it away.
Absolutely. Yeah, our team hub, step one, right? We've got 3 simple steps for you. Step one is understand just some of these basics of the money press. This video hopefully did a lot of that for you. If you need a little bit more, we've got plenty of resources on the team hub. Team stands for Traders Edge Active Member. It's our membership site with just tons of resources that you can tap into to learn these money press basics. Step 2, you want to get an account open and funded. We have our money press on-ramp series that is literally going to take you by the hand, walk you through everything you need to know to get open for business. Get that account open and be ready to start trading. And then that third step is to go live. Go place that first trade. Once you do that, even if you feel like you're maybe not ready for it, nothing forces some understanding more than starting a live position. Even if it's one contract, one small position, you're going to start learning so much in that first week of going live. And again, that money press on-ramp was built specifically to take you by the hand and get you to where you're ready to place that first trade. It only takes maybe an hour or two. So carve out a little Netflix time, carve out a little nightly news. This is going to be more fun, more profitable, and spend that little bit of time and you're going to be live and seeing some of those weekly income paychecks rolling your way in no time.
And I just want to add, that's awesome stuff. I just want to add, if you're with us to this point in this video, I want to look you in the eye and tell you thank you for your time, your attention, and your trust in going this far and listening to our presentation today. Mike, you did an amazing job, by the way.
Yeah, thanks, Preston. We want to see your success story hanging on Preston's wall next. So we can't wait to hear how you do with this strategy. Can't wait to hear how it changes your lives. And we will see you inside the Team Hub and hear all about your success.
Absolutely. Take care, everyone.
See ya.